Unless you've been living under a rock for the past week, you've probably heard lots of talk around GameStop, AMC, Bed Bath & Beyond, XRP, Silver, Dogecoin, pretty much the most random assortment of investments imaginable. And yet you've probably seen screenshots of people's investment accounts making hundreds, thousands, if not tens of thousands of dollars in profit off of these names. In fact, I'd be confident in saying that most of you probably know someone who has put some cash into one of these names over the course of the last week. Because of this, there is a lot more people who now have their eyes on the market, most of whom are totally new to the world of the stock market and investing. And no matter what way you want to look at it, there's a definite set of both pros and cons to the kind of investing activity that we've seen over the course of the last week. And so what I want to do today is to just share my own thoughts and opinions on the whole situation and to give you my take on the state of the stock market as a whole. How's it going, everyone? My name is Dan, but you can call me Malone, and today we're taking stock. A very important part of investing is being able to take a step back, take a breather, and analyze what exactly is going on in the market. It's honestly very easy to get caught up in all the hype and positive emotions when there's a run up in a particular investment. So by taking a step back and forming an educated opinion, we're more likely to be able to make sensible investment decisions that aren't going to expose us to any unnecessary or unwanted levels of risk. So what we're going to do today is as follows. First, I'm going to provide an overview of what exactly happened in the stock market over the course of the last week, to provide some context to the video. Second, I'm going to discuss the pros and cons associated with the kind of investing activity that we've seen as of late, as well as the massive influx of new investors to the stock market. And finally, I'll give you my opinion on the state of the market as a whole in 2021 and what you need to bear in mind when investing going forward. But before we begin, as always, if I could ask you to please leave a like on the video. Liking the video really does help me out a lot, as YouTube pushes the video to bigger audiences based on the number of likes that the video gets. And if you are new around here, please do consider hitting that red subscribe button below and clicking the bell for video notifications. We make financial education videos on this channel aimed at making conversations like these more of a cultural norm. So without further ado, let's get started. Alright, so let's recap on what exactly happened in the market to cause the media firestorm which engulfed all of our news feeds and WhatsApp chats. Essentially, a Reddit group known as Wall Street Bets figured out that GameStop, the company best known for giving you 5 cents for a video game that you purchased brand new yesterday, was a heavily shorted stock. So first question, what is a shorted stock? In the world of the stock market and investing, if you personally own a stock, in the sense that you go out and buy the stock yourself on the market, you are said to be in a long position. The opposite of this, as you may have guessed, is a short position, where you don't personally own the stock yourself, but rather you've borrowed the stock from someone else. Typically a brokerage such as Robinhood, Trading 212, DeGiro, whoever it may be. Stay with me now, let's put this into an example. Let's say I want to take out a short position in GameStop for one single share. To do this, I go to my broker, who as I mentioned could be Robinhood, Trading 212, DeGiro, it doesn't matter, and I ask them to lend me one share in GameStop. The broker then gives me the share and I sell the share there and then on the open market for say $100. Now this is a borrowed share, and just like if you were to borrow money from the bank, it must be returned at some point in the future. And so in order to be able to return the share to the broker, I must repurchase the share on the market at some point in the future. So what exactly am I trying to achieve here? Well, in short, the goal is to buy the share back at a price that is lower than what I sold it for, so that I can pocket the difference as profit. So when you're in a short position, you're hoping that the share price will go down and not up, meaning that you have a negative outlook on the particular company that you're attempting to short. Using our example, if the price of GameStop stock was to fall to $25 from $100, I could repurchase the share there and then on the open market for $25, return it to the broker and pocket $75 worth of profit. The catch, of course, is that if the stock starts to rise in price, you're going to lose money. Reason being is that in order to return the stock to the broker, you need to repurchase it on the market. And if the share price is going up, you're going to end up repurchasing the share at a price that is higher than what you sold it for. So let's bring this back to Wall Street Bets and Reddit. These guys figured out that 120% of GameStop stock was shorted. The reason why it's possible to short more than 100% of the stock of a particular company is because when one investor sells their share on the open market to initiate their short position, it's possible for the brokerage of the purchase investor to lend out that share to another investor who is interested in shorting the stock, meaning that there'd now be two investors shorting a single stock in issue. If that's confusing, all you need to know is that there was tons of negative sentiment and negative outlook around GameStop's future, which caused lots of big US hedge funds to short the stock in order to try and profit from GameStop's demise. So Wall Street Bets proposed that if they could get lots and lots of people to start buying GameStop stock, that this would increase the share price and force all of the investors who held short positions in GameStop to repurchase the shares that they had borrowed and sold on the open market in order to cut their losses. And because there was so many short positions held in GameStop, the frenzy of repurchasing by the short sellers would drive up the price even more, causing a feedback loop of exponential price growth. This is what's known as a short squeeze, because the short sellers are literally being squeezed out of their positions by the market. And lo and behold, Wall Street Bets was correct, and you know the story after that. The success of this collective and almost communal-like investing strategy resulted in Reddit users and retail investors banding together and targeting other heavily shorted stocks and meme investments to try and enrich everyone through manic price inflation. Okay, so let's talk pros and cons. I want to start off with the pros because I definitely do think that some good has come from this event. People made money, which is great. I've seen tons of stories online about how people were able to pay off their student loan debts and send their kids to college based on the tips that they received from the Reddit forums and also elsewhere in the community. Regardless as to what the analysts are saying or the opinions of regulators, some people did do well out of this event and are now in a better place in their lives than they were before, which is always a good thing. Second, there is tons of people now looking at the market. Granted, most of them probably will lose interest after a couple of weeks and that'll be that. But if even a fraction of them stay interested in the financial markets and are hungry to obtain financial independence, well again, that's always a good thing. We're talking about a very sizable portion of people who are now looking at their money in a new way. And this could be the event which enlightens them or encourages them to do more for their own financial well-being. Third, the line between Wall Street and Main Street has been blurred. And what I mean by that is that the retail investor has, if only for a brief period of time, shown that they have the potential to do well for themselves as a collective unit. It's no secret that the guys with all the money have a significant ability to cause material moves in the market, and oftentimes these moves make the rich richer. So it was nice to have an event which empowered the little guy and gave the average Joe the chance to see green in a very real way. But there are some cons which need to be considered. First of all, let's not be naive here. The majority of people are going to lose money on these trades. People are going to get burned by this aggressive and highly volatile purchasing activity. It doesn't matter if it's GameStop, AMC, Dogecoin or silver. Once your returns are totally dependent on market sentiment, then you are at the whim of the market. And the market is very unforgiving. Now I know what you're thinking. Malone, even the large dips in GameStop were followed by large gains at times. And yes, you are correct, but remember, hindsight is 20/20, foresight is legally blind. And it's a lot harder to convince yourself not to sell when you're down 25% on your investment in a matter of minutes. Aside from the monetary impact of the losses, I feel the emotional and psychological impact could be worse. The worst case scenario isn't that someone loses money, it's that they walk away from the experience thinking that the stock market is a loser's game and that all investing is gambling, therefore effectively preventing them from ever investing in financial assets again. And this has a detrimental long-term impact on generational wealth, because not only is that person self-sabotaging their own financial future, but they're also likely to pass on their own false learning experiences to their children, who in turn will likely be put off from ever attempting to build some sort of lasting financial wealth. Secondly, for those who did make money, I think this event could create a very real false precedent. What I mean by that is for someone who is totally new to the stock market and these kind of gains are their first experience of making money through financial assets, that it could create some form of expectation for the same kind of money making potential in their future investing activities. So the idea that certain individuals may try to replicate the returns of this event by taking on excess risk in their investing activities certainly is cause for concern. Thirdly, the lines between investing and speculating have been obliterated. Now I know, the definition of investing is very much personal. Who am I to tell you that what you're doing is investing or speculating? But I'm not trying to get hung up on definitions here. I'm more so trying to point out that for the individuals who are planning on sticking around after the dust has settled, that it's critical to realize that for stocks in particular, there there are fundamentals which can dictate the value or lack thereof of a particular investment. There's been virtually no considerations around valuation for I'd say 99% of the people who jumped on the hype train over the course of the last week. And listen, that's perfectly okay. The goal at the end of the day was to make a quick dollar. But a cause for concern could arise if individuals don't come around to understanding that valuation plays a critical role in every sustainable investing strategy. So this is the part of the video where I give you my opinion on the market as a whole right now in 2021 and what you should be considering going forward with your investments. The bottom line for me is that at one point or another, valuation has to matter. Benjamin Graham once said that the value of any investment is and always must be a function of the price you pay for it, meaning that the higher the price, the lower the potential return. The sort of frenzied buying that we've seen over the course of the last week, while obviously on a completely different scale, isn't too dissimilar to the kind of buying activity that we've seen in the likes of penny stocks and electric vehicle stocks over the course of the last year. Investors are essentially buying into the idea that an obvious prospect for physical growth will translate into massive profits down the line. And this is effectively the mentality behind investing in companies such as Neo, Workhorse and Tesla. I'm definitely not saying that you can't make money in doing so. In fact, I know lots of YouTubers who have made themselves and their communities lots of money by investing in these companies. And if that's what you want to do, then go for it. But just realize that at one point or another, the price that you pay for the investment is going to matter. Me personally, I prefer to stay out of these areas, but if I do invest in riskier growth stock plays, I make sure that they're part of a well-diversified portfolio with varying degrees of volatility. That's just what suits me as an individual. I'm not claiming in any way that it's the right way to go about your own personal investments. As for the bigger picture, I do think there are some great opportunities to pick up some stocks in some less popular areas of the market at the moment, and I also think that by doing your research, staying patient and sticking to your investing strategy, you'll be able to reap the rewards of discipline and a greater understanding of yourself as an investor, especially over the long term. It definitely is hard to fight off the temptation from getting involved in an investment which isn't really suited to you as an individual, especially when it seems like so many people are making money from it. But remember, if you're in this for the long haul, it's a marathon and not a sprint. The goal is not only to make money, but to appropriately educate yourself about the financial markets and obtain some level of sustainable financial independence. Quick disclosure, the information in this video and all videos on my channel is for educational and entertainment purposes only and is not meant to constitute advice. Please never make a financial decision based on one person's decision on the internet such as myself, and if you are unsure of any of the information you've heard in this video, I would highly recommend going ahead and contacting a professional financial advisor. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like in the video, subscribe to the channel, and I'll see you in the next one. Cheers.